Hey, it's Soleil, and this is episode 216 of the Orange Pill Investor. And today I am going to go over option Greeks and talk about how any of them might be useful. Um, I'm coming mostly from an option seller's perspective, but as I've started buying a lot of calls in MicroStrategy in particular, I I'll talk about what I look for in those as well. And it's generally just the opposite of whatever I like in a in an option that I'm selling. So if I like it as a seller, then I like the opposite as a buyer. I think that makes sense. So the first one is delta, and delta is going to be the amount that your option contract changes for every dollar in the underlying stock. So if in this case, this is let's just round this to 0.59 right here. If MicroStrategy goes up $1 per share, then this option is going to go up 0.59. And the way that I use this in general, I really don't use it for selling. But some people will just mechanically, they like, okay, I want to sell the 0.3 delta, and they'll go to whatever strike is closest to 0.3. And I think that's a reasonable starting point, especially if you're new. Like, okay, zero point 0.3 delta is probably going to give me some call away value here. And as long as the premium is reasonable, then, go for it. But I generally start with how much premium I either want to collect or how much call away value I want to build in. And then delta just ends up being whatever it is. It's also a proxy for the percent chance that I don't want to say necessarily that this will be successful, but the percent chance that it will exceed this strike. So 134 is an out of the money call. It's about what, $6 out of the money. And there's about a 35% chance that by expiration, this will expire out of the money. So about a third of the time you should expect, for if you sell this covered call, 1 out of 3 weeks you should expect to be paying to roll, or having your upside limited. And sometimes people will be like, oh, I'll just pick something up here. It'll never go to 145 this week. And not so fast. 7% of the time it should still happen. So 9 times out of 10, you're good to go. You can just collect your $30 and this strike will never be threatened. But 7% of the time, once every like 14 weeks, this is going to happen. So it just gives you a baseline expectation for, for how often your strike should be threatened. So as a seller, the delta doesn't necessarily matter to me too much. But as a buyer, the whole point of buying these calls is because buying a call gives you the right, but not the obligation, to purchase 100 shares at this price. So if I buy this 128, I'm paying $465 for the right to purchase it at the price that it is now. And that's why this break even is 132. I need the price to go up $4 like right away in order to break even on this bet. And so for every every dollar the stock goes up, if it goes up, this option will increase in price by 57 cents. But as a buyer, if I truly am bullish on a stock, I want to buy as much delta as possible for the same price. And so in this case, 58 delta is going to cost me 465. I'm going to try to find something that's approximately the same price. All right. So this is 10% of the cost of the 465. And what is it? 0.59. If I was getting 10% of the delta, then that 0.59 would have turned into 0.059. So it looks like I can get twice as much delta per dollar. Like if I spent, 9 of these and paid $450, that would give me 0.9 delta. So like way more value in these out of the money options. And that's going to be true at any DTE. So I've been stocking up on some of these long calls that are 164 days to expiration, 219, 465. And I would rather control 0.33 delta for 1869 than 0.72 delta for 53. Let's see, 63 times 18 would be what? 3654. So it's actually right about right. Let's see, what was it? A third of the price. 18 is about a third of the 54, and this is a 0.72 delta. So as long as this is over, 7 divided by 3 is 2. 21, 7. 3 goes into 21, 7 times. So is that 27? As long as I can get more than 0.27 delta here, then this is a better value. So when I'm buying long calls, I want to control as much delta as possible for the least amount of money as possible. And generally that happens like way up the top of the chain. All right, so that's delta. Now gamma is an option Greek that has an effect on delta. So this does not necessarily affect the price itself, but gamma is going to affect how much delta changes, because obviously we just scrolled to the top of the chain and delta is not the same for every single option on MicroStrategy. So as we get to the top of the chain, delta is not going to remain 0.72. And so gamma is going to regulate as the price of MicroStrategy goes up, then delta will actually increase by this 0.0025. So tomorrow, if the price of MicroStrategy is 129.85, then this will go up 0.0025 to 0.8224. And then if the price goes up another dollar, then it'll be 0.8249. And this is not factor into my trading as an option seller. All I kind of really care about is how much premium I'm going to collect and how much call away value I want to build in. But there is a phenomenon called a gamma squeeze, and it's basically the options version of the short squeeze. So most people probably remember GameStop, and let's say, okay, there was a short squeeze. There were a lot of people who were shorting the stock. And then as the price went up, the short sellers got squeezed, meaning they had to cover their positions and buy shares. And then whoever covered their shares last got screwed the most. So it's kind of like a musical chairs thing. And every time a short seller buys shares to cover their short position, they're actually making other short positions worse because it's driving up the price. So that's a traditional short squeeze. But the same thing was happening at the exact same time with GameStop because people were buying long calls. They were just having FOMO, and so they're buying more calls. Well, the people who have sold those calls, every buyer's got to have a seller. So there's people out there selling those calls, and I would assume some of them are selling naked. Maybe the market makers actually build all that risk in, and they have calculations or whatever. But as more and more people buy calls, it's driving up the price of those calls, and it's driving up gamma as well. And so as gamma starts to increase, then these short call sellers are also getting squeezed, just like the short sellers in the that have shorted the stock itself are getting squeezed. So then those guys also have to go out to the market and try to, hedge their positions and operate on some kind of neutral position. And so they're kind of doing the same thing. They're buying shares and driving up the price of the stock, which is driving up the price of the long calls and making their positions even worse. So, I guess some of us have our fingers crossed that there will be a nice short squeeze / gamma squeeze in MicroStrategy in the next year or so. So that will be fun to see if that plays out. No guarantees, but the stars seem to be aligned in such a way that it's at least possible. Not financial advice, but yeah, I don't sit here and look at gamma. I've never picked out a call or a put to sell or buy and said, "Oh, let me check gamma." But that's just, I guess it helps to know what the damn thing does. Maybe I should have started with Theta because as an option seller, this is an important stat, but I still don't check it. But here's how it works. So if I'm an option seller, this is how I make money. What I'm attempting to do is, let's just say I want to sell a put in MicroStrategy for this Friday, and the buyer's going to pay me $4,500. God, not this Friday. $4,500 for a freaking year out? No. Okay. So that actually will be kind of a good example. I'll go back to that one to talk about why I don't sell puts or calls way the hell out there in leaps territory. But for this Friday, I can get paid $350, and approximately every day, 73.73 is going to drain out of this, which kind of makes sense because there's Tuesday, Wednesday, Thursday, Friday. So 4 times 7 is 28. So that's, and then what? Yeah, 30. So approximately, $3 is needs to drain out of this option by Friday to make it worth exactly zero. Like all 300, 3.5 has to drain out. But Theta is also going to change every day. And by the time we get to 0 days to expiration, Theta is going to basically be equal to whatever value is left here. So if the market opens on Friday at like, and it's worth 75 cents or whatever, then the Theta is going to be 0.75 because there's one trading day left and all of the value has to drain out. But the way that I make money as a seller is I sell this, and then every day that this option does not go in the direction that the buyer needs it to go in, he's losing this much money from this option. He bought it for this, and this amount is draining out every day. And most options that people buy actually expire worthless. So I just pocket that money. I sell it for this, and then at the end of the week, it's worth probably next to nothing, and I buy it back for next to nothing, and I continue to do that week after week after week. Now, I can get 350 bucks this week, but why don't I sell puts out here? How many days away is it? 465 days away. So 1 1/3 years. I still would have to put up the same amount of collateral. I still only have to put up $12,800. Whether I sell it for this week and collect 350, or whether I sell it freaking a year and a half from now and collect $4,500, I still have to put up the same collateral. So why wouldn't I get more money for the same amount of collateral? And the reason is because look how tiny Theta is. This sucker is only losing 4 cents a day instead of 73 cents a day. So in the other option, I'm making $73 a day as the value drains out of that option. Whereas in this one, in 1 week, the price has only collapsed 4 cents times 5 days. That means that in a week, this thing will still be worth 45.25. So if I want to buy it back cheaper in a week, I'll have only made 20 bucks. So that's why as a seller, I never sell calls or puts past 45 days. In a situation where I really just didn't want to risk selling below my cost basis, I could be talked into going to 60 days. But for the most part, Tasty Trades research has shown that the sweet spot for theta decay acceleration, because you can draw thetas. I said that theta's value changes. Well, at 465 days, it's 0.04. And at some point, theta is increasing, but it's kind of like at a steady rate. Like you're on the highway at 55 miles an hour and you're just cruising at 55. That's what theta is doing when it's a year out. But as we get closer to our destination, theta starts to accelerate. And for out of the money options, not really at the money, for out of the money options, if theta starts to accelerate, theta's rate of decay starts to accelerate at 45 days. And so their recommendation, and a lot of times, is to go ahead and sell an out of the money option at 45 days to expiration, which today's Tuesday, so that's perfect. And then let's just see what theta does in 2 weeks. And then in 2 weeks, you're anticipating being able to buy this back for hopefully 50%. So let's go to the 31. So this is good. This is 1363. This is the 135 strike. It's 1363 and it's worth 0.18. So in 2 weeks, the 135 strike has collapsed in value from 1,800 to 1,000. So not collecting quite 50%. And theta has increased from 0.18 to 0.21. So at this point, when you first sold it, you were making $18 a day. And then within 2 weeks, you're making $21 a day. Let's go one more week. See if we can get it under that 50% profit. Boom. We sold it for 1,800. So within somewhere between 2 to 3 weeks, you would be able to roll this back up to probably 1,800 again, pocket the 900 for 2 weeks, and then Theta is going to go back up to whatever, 0.18. Oh, I can't remember what it was, 0.17, 0.18, whatever. And then you just rinse and repeat. You can do the same thing selling puts if you're going to sell them out of the money at 45 days. Doesn't even matter. But yeah, if I was going to try to sell this one for, the 122 strike for $1,000, then I'll see Theta's 0.15. So the 122 strike, let's go 2 weeks. Theta has increased from 0.15 to 0.17. And I forget how much this dropped in value. A couple $100. So that's Theta as an option seller. And generally when I sell puts, so the Theta curve is different for weekly options versus 45 DT days to expiration options. So when I sell weeklies, I like to just sell puts right at the money. Now these are pretty dangerous because if the price drops to 110, you're buying these shares for 128. But you're getting a $3.50 discount, so you're really buying them for $124.50 if you reduce your cost basis by what you sold it for. Oh, which is why the break-even price is $124.50. So the Theta curve for weekly options is highest at the money, and really kind of makes sense. Like there's no wiggle room for an for a weekly option to collapse, really. I mean, there's only a week. In a week, it's got to go from 100% to zero to nothing left. No extrinsic value left in this thing. So I don't really worry about Theta too much at the money because I know there's nothing else that can happen in a week other than the extrinsic value in this option goes to zero. Now, if it goes in the money, it can gain some intrinsic value, but all of the extrinsic value must decay from an option by expiration. So as an option seller, I want the biggest Theta I can get, which are all under, 60 days to expiration. So that's why there's some synthetic stock situations that some people can create where they would buy and sell an option 6 months or a year from now, and it creates kind of a synthetic stock. There's use cases for selling options, but it's probably as part of a spread. But just as a straight put or call seller, I want the biggest Theta I can get, and I want them under 60 days. I am not selling puts and calls at 96 months. I don't give a shit how much premium I can collect here. Now, some folks, if you really just need that money, I mean, you can do it. If you had 100 shares and you want to sell a covered call against something, and you're like, I feel like I need $2,700 and I don't want to sell my shares. I guess you could sell this covered call, but geez, in 120 days, I can't imagine that the price wouldn't go way above 133. I mean, if I'm bullish on something. So I'd rather just, between now and 6 months from now, I can sell the 135 every 2 weeks for 6 months. 4 weeks times 6 months is 24, and I can do this every 2 weeks, so 12 times. I can sell this 12 times. I'm only collecting half of it because I have to roll it, but 6 or 12 times half of this is like $7,000, whereas months from now, it was way less than 6 grand. It was like half of that. So I don't see any reason to ever be selling calls out past 60 days. Um, but yeah, definitely as a buyer, I want to go out as far as I possibly can and get the lowest theta I possibly can. So theta out here, I'm only losing a nickel a day. These ones that I like up here, yeah, I'm still losing like a nickel a day. Now, granted, that's worse in the sense that this is like what, half to a third of the price. So the percentage of this option that I'm losing per day out of the money is greater. So that is an argument against my decision to buy these out of the money options. But if I'm as bullish as I am on MicroStrategy, I would rather get as much delta per dollar as possible and have a higher theta to price ratio. I'm willing to make that trade off. And again, everything in the market and everything in options is a trade off. You can sell a covered call closer to at the money, you're going to get more premium, but the trade off is less callaway value. Same thing here. The trade off, there's a trade off here. You can buy these calls for cheaper, you can control more delta for less money, but more of, even though theta is the same out here, the more expensive option is losing less of its overall value per day than an option that's half or a third of its price. All right, so that's theta. As a seller, I want to sell big theta under 60 days. As a buyer, I want to buy tiny theta as far out as possible so that theta is the smallest. And I can speculate on this value for longer before my contract has a chance to decay in value. The last one's vague. I say the last one's vague because I'm not going to even talk about Row. Vega is the sensitivity of the options price to changes in implied volatility. And implied volatility is, to a certain extent, exactly what its description is. So if a stock is volatile, like MicroStrategy, there's a formula that calculates, I can't remember exactly what it is, but it's like the square root of something divided by 365 days or whatever. And it kind of implies how volatile a stock might be in the future based on how volatile it's been in the past. And if a stock is very volatile, or if its volatility increases, then this option price can become more sensitive to implied volatility's effect on its price. But again, this is not really something that I pay attention to. It's not like I look at this indicator and I'm like, okay, I can buy this when Vega is low, and then when Vega gets high and the price of this spikes, then I can sell it because Vega's high. Um, I guess it just makes sense to know how Vega works, but I'm not terribly aware of how Vega would be used as an indicator. But there could be ways. But me as an option seller, I'm just selling puts and calls. I don't look at Vega at all. Um, as a buyer, I suppose that if the price of MicroStrategy shoots up $10 in a day or something, implied volatility shoots up, or the price goes down and implied volatility shoots up, I suppose the reflection in the options price could be explained by going in down here and checking out Vega. It's like, oh yeah, the price changed this much based on this Vega. But at that point, I kind of just don't care why the price changed. If I bought it and the price went up, I'm just happy and I'm going to sell it for a profit. So don't really care about Vega much. And then Rho is how much the price might change based on whether interest rates go up or down. And I guess interest rates for me might have some kind of macro element to it. As rates go down, I guess the overall tendency of the market is to go up. So I might become bullish, but I'm not going to go and check Rho and be like, oh, yeah, the rates went up or down and now Rho is something. Um, there might be some other traders that trade in a certain way that Rho could be important, but for me as an option seller, it's really not. So I think that's all I wanted to talk about for now. Um, Delta can be valuable in selecting long calls, probably long puts as well. Um, Gamma doesn't really have a functional aspect to it. I don't check it. I don't really care what the value is necessarily, but you should be aware of what a gamma squeeze is and how it, how you could profit, or if you're a naked seller, get completely wrecked by it. And then big theta is good for sellers, and that generally happens at short dated expirations. Tiny theta is good for option buyers, and that generally tends to happen for longer expirations. And yeah, and then Vega's another one that I don't really check. Doesn't affect my selection at all, but it kind of factors into the calculations. All right. I think that's it for now. Be good, Joe.